Welcome to the Opening Bell Report.
We have a really compelling stack of source material today.
We do.
Specifically, it's a highly detailed fundamental analysis report, and it addresses this dilemma that I know you have felt before.
Oh, absolutely. Everyone has.
Right. The scenario usually goes like this. You're looking at the market, and you see a well-known tech stock that has surged, well over 100% in a single trailing 12-month period.
Yeah, and when you see a chart that steep, the immediate visceral fear is just simply that you're too late.
Exactly. You assume you've completely missed the boat.
It is arguably the most common psychological trap in investing. You see the rapid price action, you assume the underlying value has been stretched to beyond reason, and you just walk away.
Without even looking under the hood.
Right, without seeing if the business fundamentals have changed just as rapidly as the stock price.
And that is the exact mission of our deep dive today. We are tearing into this analysis report to answer one specific question regarding Taiwan Semiconductor Manufacturing Company, or, TSM.
Is it too expensive right now?
Or is it actually the best valued mega-cap tech stock hiding in plain sight? To set the table, the report lays out some current metrics. TSM is sitting at a stock price of around $353.86.
Which is substantial.
It boasts a market cap of roughly $1.83 trillion.
Trillion with a T.
Trillion. And it's trading at a 34.06x trailing PE ratio.
Those numbers demand attention. And it's really crucial to understand why you should care about them, even if semiconductor manufacturing isn't your usual sector.
Why is that?
Because when we analyze TSM through the lens of this report, we aren't just looking at another large-cap hardware company. We are looking at the physical foundation of the entire AI era.
The physical foundation.
Yes. Everything we discussed today, from their margins to their cash flow, it all flows directly from that single reality.
Okay, let's unpack this, because we have to address the valuation paradox right out of the gate. For a long time, historically speaking, TSM traded like a standard cyclical hardware manufacturer.
Very cyclical.
The report notes that its PE ratio used to sit comfortably between 15x and 20x. But today, as I mentioned, it's at roughly 34x trailing, and the forward PE is sitting around 27x.
Right.
On paper, to a traditional value investor looking at that historical baseline, multiple expansion of that size looks incredibly pricey.
What's fascinating here is how the market has fundamentally repriced the entire business model. The analysis report draws a very sharp distinction.
How so?
Well, TSM is no longer just a cyclical chip fabricator whose fortunes rise and fall with the seasonal demand for consumer electronics.
Like smartphones and laptops.
Exactly. The market now recognizes it as a structural monopoly.
Right.
The reason you're seeing that higher multiple is due to what the report calls the AI premium.
The AI premium?
Yes. The market is forward-looking. It's pricing in the reality that the infrastructure required for artificial intelligence simply cannot be built without TSM.
The report actually uses an analogy to explain this AI premium that I think visualizes the situation perfectly. It describes TSM as the exclusive toll booth for the global AI infrastructure build-out.
It's a great analogy.
Imagine being the sole manufacturer producing the critical components for NVIDIA, AMD, Apple, and Broadcom.
The biggest players in the world.
Right. If any of those companies want to participate in the AI space, they have to pay the toll to TSM to physically build their most advanced designs.
That toll booth analogy is particularly apt because of how the semiconductor industry has stratified over time.
What do you mean by stratified?
Well, years ago, many tech companies designed and manufactured their own chips. Today, the industry is totally split. Companies like NVIDIA and Apple are fabless.
Meaning they don't have fabrication plants.
Exactly. They design the architecture of the chip, but they do not possess the multi-billion-dollar plants required to actually print them at a microscopic scale. TSM has positioned itself as the undisputed king of that physical manufacturing process.
I understand the toll booth concept, and I know a lot of people listening are wondering, a 27x forward multiple assumes that toll booth remains completely uncontested.
Sure.
Why couldn't a competitor with deep pockets just build their own fabs and undercut TSM on price?
That is the logical counterargument. But the report provides a really sobering contrast with TSM's competitors to illustrate why that just isn't happening.
What's the contrast?
TSM has unprecedented earnings visibility. Their order books are locked in years in advance by those exact tech giants you mentioned.
Years in advance.
Yes. And when you look at the competition, the moat becomes obvious. Intel, for example, is facing collapsing earnings and severe foundry operating losses.
Yeah, we've seen those headlines.
Their PE ratios are fluctuating wildly because they are struggling to master the manufacturing yields on the most advanced chips.
And what about the other guys?
Well, trailing edge foundries, companies like global foundries that make older, less advanced chips, they're stuck with stagnant growth. TSM is effectively standing alone at the vanguard of advanced manufacturing.
Okay, it's one thing to have a strong narrative and a structural monopoly, but to justify a near $2 trillion valuation, a company has to execute flawlessly. The analysis report dives deep into the financial engine of TSM, and the top-line acceleration is hard to ignore. We're looking at revenue up 35.9% year over year.
It is really worth pausing on that figure.
It's massive.
Growing at 35.9% when you're a small, agile software startup is expected. Achieving that kind of percentage growth on a base of this size is a different story entirely.
The revenue hit $122.42 billion.
Billion.
Yes, billion. The report points out that this acceleration is happening while legacy tech peers are struggling to stay flat. I mean, many are eking out single-digit growth at best.
Which is standard for hardware right now.
But the revenue growth isn't even the most surprising part of the income statement. The report highlights a 59.9% gross margin and a 48.3% net profit margin.
Those numbers are staggering.
Given that hardware is notoriously capital-intensive, how are they pulling almost half of every dollar down to the bottom line?
If we connect this to the bigger picture, a near 60% gross margin in a hardware business indicates undeniable, almost absolute pricing power.
They can charge whatever they want.
Pretty much. Building global fabrication plants is unbelievably expensive, especially with current supply chain and geopolitical pressures. But TSM is successfully passing the massive costs of those fab expansions directly onto their clients via 3 to 5% price hikes.
And the clients just take it.
They absorb the hikes without hesitation because of that toll booth dynamic.
They simply have nowhere else to go if they want their designs printed at scale.
Exactly.
The report actually refers to this as having software-level profitability in a hardware business.
Which is unheard of.
But let me play devil's advocate again. We hear about semiconductor gluts in the financial news constantly. The pandemic caused a shortage, then production ramped up, and suddenly there were too many chips in the market.
That's the classic semiconductor cycle.
Right. So if TSM is passing on price hikes and printing money now, what insulates them from the next cyclical glut?
That is where the product mix becomes the most vital metric in the entire report. TSM is not producing a homogeneous product.
They aren't just making generic microchips.
No. The analysis highlights that advanced nodes, which the industry currently defines as 7 nanometer and below, now make up over 77% of TSM's total revenue.
Let's contextualize that for a moment for anyone who isn't deep in the hardware weeds. When the report talks about 7 nanometer and below, we are talking about the physical distance between transistors on a chip.
Right. Microscopic distances.
And the smaller that number gets, the more computing power and energy efficiency you can pack into a single piece of silicon. And that computational density is an absolute prerequisite for training and running large language models and advanced AI.
Precisely. And that concentration in advanced nodes is what makes TSM heavily insulated against the inventory gluts that drag down the rest of the sector.
So they aren't feeling the glut at all.
Because the world currently has an oversupply of basic microcontrollers. The older, larger legacy chips used in microwaves, standard automotive applications, and basic consumer electronics.
The trailing edge stuff?
Yes. But there is an insatiable, unquenchable demand for the sub-7 nanometer chips required for AI accelerators and high-end smartphones.
So they just bypass the glut completely.
By shifting over 3/4 of their revenue into that hybrid advanced space, TSM sidesteps the cyclical downturns that routinely punish trailing edge foundries.
The margins and the revenue growth paint a picture of a very healthy income statement. But in a capital-intensive industry, the income statement only tells half the story.
Cash is king.
The true test of a company's ability to survive, adapt, and dominate its sector long-term is its cash flow. The report breaks down TSM's pure free cash flow.
This is the crucial part.
Out of that $122.42 billion in revenue, they generated $31.94 billion in pure free cash flow. That equates to a 26.3% FCF margin.
That metric is the ultimate separator. It isolates TSM not just from direct semiconductor competitors, but from many other members of the broader tech landscape,
It's an ocean of cash.
generating nearly $32 billion in free cash flow after accounting for all operational expenses and capital maintenance is a rare display of financial fortitude.
It really is.
It means the company isn't just profitable on an accounting basis, it is generating an enormous surplus of actual deployable liquidity.
And here's where it gets really interesting. The analysis report doesn't just look backward at the trailing metrics. It lays out TSM's guidance for the upcoming year.
The forward look.
They are aggressively gearing up for the next generation of manufacturing, specifically their 2nm or N2 capacity. To achieve this, TSM has announced a capex guidance of $52 billion to $56 billion for the coming year alone.
The sheer scale of that number is difficult to overstate. Spending up to $56 billion on capital expenditures in a single 12-month period is a historically aggressive move.
It's a massive bet.
But here is why that figure is the linchpin of the bullish thesis for you as an observer of the tech space. TSM is entirely self-funding this leap into the 2nm future.
Out of their own pockets.
Because they possess that 26+% free cash flow margin, they are financing this monumental infrastructure build-out straight out of their own operating cash.
Which means they are avoiding the typical traps of hypergrowth in the hardware space. They aren't taking on dangerous levels of high-interest debt.
No.
And they aren't forced to issue new stock and dilute their existing shareholders to raise the capital. They are effectively building a financial fortress.
And the report provides a crucial reality check by looking at how the competition is trying to manage the same technological transition. It directly contrasts TSM's self-funded model with Intel's current predicament.
How is Intel handling it?
Intel is actively burning through cash and running negative free cash flow margins. In their attempt to catch up technologically and build out their own advanced foundry business, their capital expenditures are far exceeding the cash their operations actually generate.
They're spending money they don't have.
They're spending money they haven't made yet. TSM is outspending the entire sector on research, development, and fabrication, and they are doing it without stretching their balance sheet.
They are simply operating in a different financial reality than their peers. But let's bring this back to the core question of the analysis report.
Sure.
TSM is investing $56 billion to build the N2 nodes. They have a massive lead in the sub-5nm space. They have 48% net profit margins and over $31 billion in free cash flow. So what does this all mean for the valuation?
When you synthesize all those fundamental pillars, the verdict on the valuation multiple becomes much clearer. The final analytical point the report drives home is the concept of relative value.
Relative value.
Yes. If you strictly compare TSM to its own past, back when it was a standard hardware manufacturer heavily reliant on smartphone cycles, a roughly 27x forward multiple seems like a steep premium.
It looks expensive in a vacuum.
But valuation cannot be assessed in a vacuum. You have to evaluate the stock against the current market landscape.
And the current landscape has placed an enormous premium on anything touching artificial intelligence.
Exactly. When you look across the mega-cap tech sector right now, you routinely see companies trading at 40x, 50x, or even 80x forward earnings.
High valuation.
And many of those companies are trading on the promise of future software applications or theoretical AI services. In that context, paying a 27x forward multiple for TSM, the company that is quite literally manufacturing the physical processors powering all those other companies, begins to look less like an expensive stock.
And more like a relative bargain.
The fundamentals, the locked-in order books, and the sheer volume of free cash flow suggest that the valuation is not based on speculative hype, but on a highly defensible structural monopoly.
I think that shift in perspective is the real takeaway for you listening today. We started this deep dive with that familiar feeling of looking at a stock chart that has doubled and assuming the opportunity has passed.
It's so easy to do.
But when you move past the historical price tags and focus deeply on the structural moats, the flawless execution at massive scale, and the self-funded cash flow, the narrative flips.
It really does.
Sometimes the most dominant and vital player in an entire global supply chain is actually the most reasonably priced, provided you know exactly which financial metrics to look at.
It forces a reevaluation of how the entire tech ecosystem operates. And this raises an important question, one final lingering thought for you to mull over as we conclude.
What's that?
We've spent this deep dive establishing TSM's impenetrable financial fortress, their massive free cash flow, and their absolute dominance in advanced manufacturing. The analysis report makes it abundantly clear that they are effectively the sole engine capable of powering the AI era's physical infrastructure.
Right.
But consider this. If one single company is entirely self-funding the hardware future of global technology, while its competitors spiral into operating losses trying to catch up, at what point does that absolute technological monopoly become a broader market liability?
That is a fascinating angle.
When the entire multi-trillion-dollar tech sector's roadmap is physically bottlenecked by one single entity's fabrication capabilities, the definition of systemic risk changes entirely. It is something to watch very closely.
A vital dynamic to keep in mind as you assess the broader market. Thank you for joining us on this deep dive into the underlying fundamentals of TSM. We hope it gave you a framework for evaluating companies that are breaking out of their historical molds. Keep questioning the consensus and keep exploring the brilliant insights hidden within your sources. We will catch you next time.
Don't forget to like, share, and subscribe for more.